Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And the day has come. It's the 28th of July. I'm actually recording this on the 21st of July, so a week earlier. But 28th of July, this podcast will come out, and this is the day the book is released. So Wealth by Design, I think you'll be sick of hearing about it. But look, it'll be Amazon and all the bookstores will start to send it out, and you'll start to see it in bookstores physically. So look, I hope it is well received. If you've purchased it, I hope you'll enjoy it. I'm really interested to see how the feedback is for the Notebook LM tool that I've built with it, which is really an AI tool trained on the book, and you can ask it questions and apply the concepts to your circumstances. So I reckon it's going to be pretty good, but I'm crossing my fingers as I'm recording this and saying this. I hope it's going to be good. I hope you like it. I hope it helps heaps of people. And of course, I hope you share it. So, the more the merrier, of course. You sit down and write a book like this, it takes a lot of time. And every time I write a book, I say to myself, I'm never doing that again. And I'm going to say it now, I'm never doing it again. And anyway, let's see how we go. Let's hope it, really works in terms of adds value and so forth. Before we get into today's episode, I wanted to talk about, just made some general comments about the market. May we live in interesting times, I think is the saying. We certainly do. I mean, there's a lot going on, isn't there, both domestically and internationally. Of course, we've had, the Iran thing still going on. We've got trade and tariffs and all these sorts of things. And, every morning you wake up, if you're like me, you wonder what the news is today. What has Mr. Trump done overnight? What's he saying now? Where's the direction going to go? We've had a few bumps in the road with the AI trade. As I said, I'm recording this on the 21st, so it could all be changed by then. But, some of the semiconductors have sort of come off. And I don't think it's a big deal. So Moonshot, which is an AI tool, a Chinese AI tool, people are sort of saying, well, maybe, that China's going to win the race in terms of cheaper and better and faster. But I think there's always going to be a reluctance of, when businesses uses AI, they always think about, the first thing they think about is data security, right? So I don't know. I don't think I'm not saying I believe all the hype in AI trade, but I don't think, one little product's going to move the dial too much. And, closer to home, of course, we've had lots of debate and feedback around the tax changes, which is kind of interesting. As I said previously, I think the tax changes are going to become more and more unpopular. I even saw some commentary in the last couple of days about, that it hasn't helped first home buyers yet, and that's what it was supposed to do. You wait, that'll just get louder and louder. So it's moving in the direction that I suspected, which I don't think I'm sticking my head out by saying. It's not like I'm saying it's going to be popular. So I think it's, what everyone thinks. And in the next week or so, I'm going to publish a decision tool that you can use to help navigate the tax changes. So, what should you do now? What should you do over the next 12 to 18 months? What you should do longer term to sort of help you make those decisions. And in that decision tool, I've got 6 questions you kind of work through, and then it comes to a particular conclusion with a checklist and so forth. So I put that together, and it's really the combination of a bit of work that I've been doing plus some additional work to really help people kind of navigate a really difficult time. So I'll be sharing that, and you can access that for free, of course, and use it to sort of help navigate this time. In early August, I've got a blog coming out around, what strategies could you still employ with established residential property to achieve the same outcomes as you would have before negative gearing quarantining. So just really workshopping through all the things that I think are going to be sort of talked about over the next couple of years. So that'll kind of add to that content. So I just wanted to flag that. And tomorrow I'm releasing the How to Choose the Best Super Fund for You report, which is the first year I've produced the report. I promised I was going to do it last year, and I'll update it every year. So it's really a tool that you can use to make sure, choosing the right super fund is probably one of the most important decisions you can make in terms of not everyone's going to invest in property, not everyone's going to invest in shares, but everyone has super. So everyone needs to make this decision. And that's why I'm saying it's one of the most important. And what I've done is I've come up with a framework to help you choose the best super fund for you, depending on a couple of sort of 3 pillars, if you like. Anyway, it's very detailed, about about 40 pages, believe it or not, but you don't need to go through the full 40 pages. Part A, or part one of the report, is really the 3 flow charts that you sort of work your way through. And if the answers to the four flow charts is the same super fund, then it gives you a high confidence answer. If it's different, then you sort of work your way through it. But so it's only if you need more detail on the factors that you want to consider, or you want to sort of educate yourself a little bit further, do you read the rest of the report. So I'll put it together in a way that hopefully is easy to understand. And I think it will be I hope it's going to be some helpful content that, again, just another, if you really enjoy it, like the book, please share it. The more the merrier. I put a lot of time and effort into these things, and I hope to help as many people as I possibly can, because, Pro Solution, my business, of course, we can't help everyone, and it's impossible. And so my answer to that, or response to that, is let's try and help as many people through this sort of medium. And then, if we get to meet prospective clients out of it, fantastic. So anyway, okay, let's get in today's episode. Okay, first question is from Kate. Kate's 49, one child, 14 years old, earns $157,000 a year, owns her own home worth 1.3 with no mortgage, but it's jointly held with tenants in common with my mum, who's 78. Super balance is $810,000, contribute an extra $750 per fortnight into super, and have about $103,000 in a Vanguard portfolio, and contribute $750 to $1,250 a fortnight into that portfolio. Should I buy an investment property or keep doing what I'm doing, or borrow to invest in shares? I'm a police officer and plan to work until I'm 57. So 57, you've got an 8-year time horizon. I probably wouldn't gear substantially, but what you might want to consider is using some internally geared ETFs. Maybe not right now, but if there is some market volatility, might be a great time to jump into those. And I talked about that in episode 300, which is it safe to borrow to invest in shares? So I've done a few different topics on borrowing to invest in shares. Of course, property is off the table now because of the quarantine negative gearing, but I think it would be off the table anyway because you've only got a 8-year time horizon, which might be enough, but it's probably not. It's probably too aggressive and probably retards your ability to retire at 57 rather than enhances it, because in 8 years' time, the property is still going to be negative cash flow. So not only do you have to pay for your own living expenses, but now you've got to fund a negatively geared property. So despite the changes, I don't think it would have changed your strategy. I don't think I'd be doing that. Some level of gearing strategically used. So when, markets correct, or if markets correct, no, it should be when, because they're going to. That wouldn't be so bad. But I guess the other thing we want to think about too is the bridging period between age 57 and 60 being able to access super. So I guess that's what you're using those Vanguard investments for. I think that'll be fine. But, I'm just sort of thinking out loud, if you like. And I guess what we want to try and do is maximize them as much as possible. You probably want to work out, how much is 3 years worth of living expenses plus a bit of a buffer. And then once you feel like you've achieved that amount, then I'd probably start directing more into super. So, you've got about 100,000 in Vanguard now. At 7% in 8 years, it's going to be maybe 180,000. That's probably not going to be enough, right? So probably keep putting in $1,000 a fortnight for the next, couple of years. Let's see how returns go. And then what I would do is I'd switch those numbers around and contribute more into super and less into that portfolio, because you don't want to actually end up with too much money outside super. If you're going to have any investment monies post 60, you want to have it all inside super. So I think you're on the right track. You're obviously a good saver and investor. You just want to make sure that super is wisely invested. So, tomorrow's episode's perfect for that. And that's why I say it's a really important decision, by the way. So if you look at, for example, Kate's position, virtually all, more than 80% of her investment assets are held in super. And so not only is performance over the next 8 years important to her, because if the next 8 years years it doubles and she's got 1.6 in super, she's going to feel really confident retiring. But if she doesn't, if she has a lower number, she might not feel as confident. So yes, the next 8 years are important, but I would argue the next 40 years for Kate, hopefully even longer than 40 years, but the next 40 years is important. So it's funny when we think about our time horizon, and I've made this point a number of times, we tend to think about it as if like we've got this life event at age 60 that we're going to retire or whatever the age is. But actually our time horizon, if we're in good health and we assume that we're going to be in good health as much as we can control this, of course, and of course, medical treatments and AI and these sorts of things will start to have an impact on longevity. So if we make those assumptions that we're going to be around for a while, then our time horizon, our investment time horizon is much longer. A point I'm trying to make in terms of people not being too conservative, how they invest their super. So Kate, I think keep doing what you're doing, keep it up, maybe add some internally geared ETFs. You don't need to worry about then, gearing personally against your home loan or do anything like that. And then, don't put too much into the portfolio outside of super. Once you've got enough for that 3-year period, start putting more money inside super as it's a better taxi environment. All the best, Kate, and thanks for listening. Okay, next question is from Slav. Really good question. I've read the second part. It's a 2-part question. So the first part is, in March 26 in the Q&A and earlier episodes, you discussed buyers in regional areas or outer suburbs who saw gains from a rising tide over the past 5 years despite weak long-term fundamentals. I'm in that position exactly where I bought 2 Queensland regional properties that grew by more than 40%. Wow. Over the last few years, and allowed me to buy a third investment property using equity in the Melbourne outer suburbs, which I hopefully will benefit from a change in cycle over the next decade or so. Okay, Slav, I've made those comments, but I actually did a podcast episode on it, episode 381, which was really about, don't extrapolate past growth and think it's going to continue into the future. Anyway, Slav's question goes on. You said that if and when the growth eventually stalls, that listeners should either sell and reinvest in a stronger location or move closer to the CBD or hold and accept the risk of slower long-term growth. My question is, how do you know when to do this exactly? How do you track the change of cycle? I know you can't precisely time the market, but some guidance would be appreciated. It's a great question. So I still hold the same opinion in that there's been some areas of the market that have grossly outperformed, just the general markets. And those markets and it doesn't tend to make sense, right? Because those markets don't have a lot of fundamentals. But don't worry, it happens in all markets. You see plenty of stocks that are listed here or in the US or wherever they are, and they can be darlings for a while, but, the fundamentals are really weak. No cash flow, no profitability, poor revenue growth, these sorts of things, but they can still be overvalued. It comes home to roost it at some time in the future. I mean, I've spoken about those sort of stocks here in this podcast. Guzman and Gomez, was one, that listed in 2004, ridiculous valuation. The share price got to about nearly $43. It's currently $22. So half of the value. It's still got a market cap of more than $2 billion and a price earnings ratio of 130 times, which is sane and doesn't make sense, right? So these things happen where you get segments of markets or stocks or property, that becomes overcooked regardless of fundamentals. I think what you want to do if you're in that situation and you agree with me that, it's about then the best use of that equity. And sometimes people go, well, I don't want to sell because they're going to pay capital gains tax. Yeah, okay. That is a negative and I acknowledge it, of course, because the tax drag on your investment is an issue. But I guess the flip side to that is, well, any capital gain post 1 July 27 is going to be taxed at a much higher rate anyway, so you're keeping less of it. The other argument would be, hang on, but we're not going to get negative gearing anymore. Well, I guess after a 40% uplift in value and the eventual flow through of higher rental, you're probably not going to get negative gearing on those assets anyway. I mean, they'll start to become positive cash flows, so what you're forgoing there isn't a big issue. But what you don't want to do is move too early. That's the risk. We can all probably typically, or most of us will conclude, yes, Stuart, I understand there's no fundamentals there. It will eventually peter out. And when it does, values could either come off or just go sideways for a long time. Typically, as long as it doesn't become too overcooked, typically what happens is property just goes sideways. But you have to understand that if you leave it too long and you see past the peak of the market, you might take a 10% haircut. But then if you sell too early, you might sell before, there could have been another 20% uprise, right? Uplift. So I think you're probably inclined to hold slightly longer than sell too soon based on that logic. And so what I would be looking at is a return of fundamentals. So when you have a look at most of the data at the moment, even the most recent data, some of which I think I've spoken about in a podcast, that the top quartile of properties, so the higher priced properties, are falling by more than the lower quartile, which is unusual. You wouldn't normally see that in terms of affordability and uncertainty and so forth. Normally, more fragile households feel it more than more wealthy people. But so that's unusual. So I think what we'll probably see is a renaissance, a resurgence in Melbourne and Sydney, resurgence in luxury property market. When that happens, it'll probably be a market signal for it to turn around. But, that's at a macro level, and this is the challenge is with property data and property commentary. It tends to be at a macro level, and it has to be, right? Otherwise, we can't sit here and talk about a particular suburb. Firstly, the data set isn't big enough for us to extrapolate anything that's meaningful. And secondly, if you're not interested in that suburb, then it's going to be a completely uninteresting conversation. So of course, we talk about these things on a macro basis, but we really need to take that, take maybe 50% macro and then 50% sort of what's going on in the local area market. What are sales doing? What are agents saying? These sorts of things. But you only can test that in inverted commas, a normal market. And because of the taxation changes, we don't have a normal market, and we might not for a couple of years. So again, I would err on the side of conservatism and hang on to them until we see a normal market. And at some point, the rhetoric, and maybe in this podcast too, will change from, okay, those outline areas are starting to see price declines. I wouldn't worry about a price decline too much, because I think selling too soon is probably your key risk, particularly when affordability is compressed, right? You've got high interest rates and compressed borrowing capacity compared to 10 years ago. That still will push more people into those regions, and maybe the higher rental yields, particularly if we've got quarantine negative gearing, that'd be an attraction too. So, Slav, no one's going to ring a bell, I guess, but I would probably say hang on a little bit too long is not a risk, I don't think. I mean, because you can't time the market perfectly. And I think just, follow the rhetoric and the data and the commentary around what's happening at different price points, and you'll start to sort of build a bit of a picture. But congratulations on getting into the market, making the decision, making a really quick gain, which is fantastic. And might be, partly luck. I don't want to criticize you, but, you kind of in the right time, right place. It's fantastic. I would be thinking, if I was in your shoes, let's take the profit. It's a little bit like at the casino. If you're up, that's the best time to leave and put it in something that has stronger fundamentals. Okay, the second part to Slav's question is, with AI rapidly disrupting white-collar jobs, I'm seeing rising unemployment, redundancies across industries. Even if new roles emerge, the transition may be slow, increasing risk of recession. My partner and I are currently employed, saving 50%, I guess 50% of the income, and can comfortably hold our 3 investment properties with some negative gearing. We rent and have strong cash flow buffers and no primary place of residence. But if we both lost out, so I just worked out what you probably should do when you sell your properties is go and buy yourself a primary place of residence with an investment lens, of course, if you're able to do so, if you're living and working in a location that is investment grade. Anyway, but if we both lost our jobs for an extended period, how sustainable is a 70-80% loan to value ratio portfolio? Would it make sense to hold through that risk, or should we consider selling some investment properties after recent growth to reduce the risk and improve resilience? Well, if you've got, look, I think long-term unemployment, voluntary unemployment is a substantial financial risk. And no, you couldn't hold a portfolio geared at 70-80% through something like that. You would need to make a change. But in my experience, I don't have your age here, do I know? In my experience, the people that worry about unemployment probably don't need to, and the people that don't probably should. So the people that worry about unemployment are the ones that are quite prudent good and, always sort of networking, got good networks to fall back upon, reinvesting in themselves, making themselves more valuable, these sorts of things. They're the sorts of people that then worry about, employment longevity, whereas the people that don't do any of those things also don't worry about it. So it's kind of ironic from that perspective. The whole point of buffers is that if something like that, an unexpected event like that happens, that you've got enough financial buffers to see it through. So if you've got strong savings, and I think that's what you're saying, then hopefully, and you can last a couple of years, then you should be fine to hold through that period and not interrupt your investment strategy. Just to give you an idea, for very junior jobs, I would say a period of 3 to 6 months is probably what, at worst, you would expect. For very senior roles, it can take up to a year to find another job, particularly if you're in your 50s. It just tends to take longer. People are a little bit more choosy, those sorts of things. So if you've got a couple of years worth of living expenses, you should be able to get through it, I should say. And I wouldn't adjust the strategy just for that potential risk. Remember, it's potential risk. And really the biggest potential risk is that you're unemployed for longer than 2 years if your buffer lasts that long. And you can make some decisions before you get there, right? So if after a year you're no closer and you've got less confidence of getting a job, well, then you might change your strategy. Don't change it before the risk materializes if you've got those buffers in place. At least that's the way I think about it anyway. So anyway, Slav, thanks for writing in. Hopefully that helps answer your questions, and hopefully it gives a bit of context for anyone that's in a sort of similar situation as well. Okay, next question is from an anonymous listener. I've been listening to your podcast for about 12 months now. Really appreciate having someone to talk investments with. Whilst we don't actually talk, I often find myself nodding and occasionally responding as I listen. Actually, it's funny. Whenever I do presentations with Campbell, sometimes I watch them back just to see if they're okay, but I'm sitting there nodding all the time like an idiot. Anyway, it's funny that people might be doing the same sort of thing while listening to a podcast. Okay, and now the person's just going to give me a bit of a rundown. So married with 2 children, aged 7 and 9. She's 44, husband's 50, own their home in Kingscliff in New South Wales with about 1.7, has about 120,000 of cash. Super is about 530 in total, and they do make some extra contributions. And they have 86,000 invested in some ETFs. She earns 150, husband earns 80. And at the moment they're putting about $1,000, or no, actually, it's about $750 a week into the ETF portfolio. And the goal is to retire in the next 14 to 16 years, different for him and her. And the question is it too late to invest in property? And they think they could service about $500 a week in terms of negative cash flow, or do they just gear into ETFs? They're having trouble. She's having trouble sort of working out which is the best way to go. Her father passed away recently, and so over the next 20 years, obviously mum's still around. Maybe there's an inheritance of between $500,000 and $1 million. So what would I do if I was in their situation? Well, it's kind of interesting that, it kind of links to the question I answered previously about Slav's question in terms of, what's happened to more affordable markets. I say more affordable, so regional, outlying, suburban locations. So they've had a lot of strong growth, right? So what is positive for Slav is negative for this listener, because if this listener jumps into that market, so sorry, I've stepped ahead here. We've got $500 a week, so $2,000 a month. What is that? $24,000 a year, circa, to fund a property. That's not going to get you probably something that's an investment grade location. So then you're going to be buying the same type of property that Slav bought 4 or 5 years ago and has enjoyed a 40% uplift. So how comfortable are you as an investor to buy something that costs today 40% more than it did 4 or 5 years ago? You start to become a little bit concerned about that. And I'm not saying the bottom's going to fall out of that market. I mean, I don't really know. I suspect it won't. But, that's the risk when you've got to really think carefully about cycles. And I talked about a value-based asset allocation, in rule number 7 in Wealth by Design. This is the application of that, is where is the best value at the moment? That's what this listener needs to be thinking. I don't think it's that sector of the market. Now, of course, you need to then overlay negative gearing and CGT and all that sort of stuff on top of it. But what I wanted to do is answer the question ignoring the tax changes, because irrespective of the tax changes, even if those changes weren't made, I probably still wouldn't be saying go and buy yourself an investment property for those reasons I just outlined. So I think you're a little bit away from it from an income and cash flow perspective. I think if you go to invest in property, you'll end up compromising. And look, that's worked out for someone like Slav. Again, no criticism of Slav, he's done really well, but that's worked out in that circumstance. As I said in his answer, maybe partly because of luck, right time, right place, but I don't think that luck is going to repeat itself. You're obviously going to get some sort of inheritance in the future. I know people are reluctant to include it. It kind of feels a bit crass sometimes to say, oh, look, my parents are going to die soon and this is the money I'm going to get. But you don't want to necessarily rely on it. But it's always good as to know to, just generally and say, okay, there's going to be something coming here. So, I mean, the point is really that at the moment, I was going to say this listener has about 550,000 in super. Well, we can kind of regard it as, say, $1 million, if you like, in investment assets if we include some sort of level of inheritance. Of course, we don't know the timing of that and the amount, but at least we know that there's going to be something and we're not solely and wholly reliant on that. But I guess the other thing too is there's no home loan, there's no debt at the moment, which is kind of good. Good and bad, by the way. Debt forces you to, it's a full savings mechanism. Without debt, you don't have the full savings mechanism. That's not a criticism of the listener, but sometimes introducing debt into a strategy, then you know where the cash flow is going and it's supporting an investment that's going to deliver returns. Then it's almost like a forced investment, if you like. That's one of the benefits about introducing debt into a portfolio. Let me just run through and critique this listener's portfolio. I don't mean to pick on them, but I thought it'd be worthwhile just to share my thoughts about how I would look at it, because I think the answer here, to my mind, is why don't we borrow against the home and invest in the share market? Why don't we do that relatively aggressively over the next 2 or 3 years, then turn it off and then put only savings and cash flow in that portfolio? So kind of a little bit like the investment property scenario, but with a little bit less gearing and be a little bit more prudent along those lines. So the portfolio at the moment, they've got 86 grand invested in ETFs. There's a bunch of ETFs here. Let me just run through them and give you some commentary. The first one is VEU, which is a Vanguard ex-US index, which is really invests everywhere except the US. So it's quite heavily centered in Europe, Japan, and has some emerging markets. I really like it because it's ex-US. Then they've got most of the portfolio, like about 60-70% in VAS, which is Vanguard Australia. Forget about Australia. I can't see where the returns are going to come from. I wouldn't necessarily divest of it, but I wouldn't be putting any more money towards that. VTS, which is a US all market, it's market cap weighted. You pretty much put 40% of your money in the top 10 stocks. In the US, I don't like it. You've got NVDA, which is obviously NVIDIA. There's some Berkshire Hathaway in there. They're only small holdings, but you know what I think about direct share investing. VDHG, which is Vanguard Diversified High Growth. And then there's a couple of listed investment companies, small amounts, AFI and ARG. Wouldn't bother with them either. The returns aren't any good. So really, we've got a few rats and mice, but most of it is in Vanguard Australia. That's most of it. And then we've got a little bit of Vanguard Total US Market and then Vanguard ex-US. And really the Vanguard ex-US and the VDHG, Vanguard High Growth, they're the only two I really like. So if I'm going to gear into it, so the reason I don't like the US market is, because it's the US market. I don't like direct share investing, so you can knock those other two out. I don't like listed investment companies, that's active management. The performance just isn't there. You go and track it. And both of those are trading at below net tangible asset value. So actually, you're not even getting the value underlying it, just the market's always traded them at a discount. They've never come up to NTA. So they're no good. There's only 2 ETFs in there that are actually any good. And so this is the challenge, I guess, that underlies a strategy like this is which ETFs you're going to invest in. Because I'm going to be a bit mean here, because you've demonstrated an approach to be a bit scattered, I would say put it all in diversified ETF. Go all growth. Vanguard's got an all growth diversified ETF. So has Beta Shares. One or the other. You probably don't need both. The crossover, the similarity between the two are going to be pretty similar. I think Beta Shares is slightly cheaper, so you might go that way. I'm pretty sure the ticker code is DHHF. and the internally geared one is GHHF. Just go DHHF for now because you're going to use some gearing. And then so what you might decide to do is you might gear like 300 grand. I don't know, work it out with your cash flow, 300 grand or something like that. Then if that's the case, maybe you borrow, progressively draw down on a loan $100,000 a year, put it into the share market. If there's a massive dip or correction, maybe then you bring forward and invest a little bit more. Maybe it's not 3, maybe it's 150. I don't know what it is. You need to work out from your cash flow and what's affordable. But that's probably the strategy that I would pursue. Otherwise, if you're not going to go a diversified ETF, why don't you then try and build your own diversified ETF? I really like VU because it has some emerging market exposure as well. But you could go VU, 70% kind of goes into VU, and then you put 30% into a US ETF like QUS, for example, which is equal weight US. You're going to still be underweight US, but at least then you've still got some exposure to that market. Or you might even go 50-50 in those two ETFs. But really what you want to do in this situation, and I haven't obviously spoken to this person, and so I'm making assumptions here, pretty broad assumptions. But my main concern with saying, oh yeah, just gear into an ETF portfolio is, what are we going to invest in? Will the portfolio be all over the place? If it's not well constructed, gearing magnifies results, positive and negative. So, you could end up being worse off. So that's my problem. I think strategy wise, it's fine. And if you get, an advisor that's putting the portfolio together, constructing the portfolio for you, it's a great strategy. But if the portfolio construction piece is the weakest part, then it's going to sort of fall over. So that's why I wanted to sort of walk you through the ETF portfolio, not particularly pick on this listener, but just give you some insight on what I see, what I wouldn't do, and how I'd take a different approach. So the underlying conclusion then is, if you can follow a deliberate approach and not mess up the portfolio, so either stick to a diversified ETF or put it in 2 or 3 very fundamentally sound, very diversified ETFs, not Australia, then do that strategy. If you can't, then look, maybe you got to pay for advice or, get someone to help you that has a little bit more experience around that. But I think no to property, even irrespective of the tax changes, and, gearing into an ETF portfolio, you've got 14 to 16 years, sorry. That's a long enough time horizon. Get that gearing in early in that time horizon, benefit from that compounding capital growth together with your super, and the backstop is inheritance. All right, just conscious of time, so I might leave it there today, just to let everyone know I'm around about 20th, 21st of April in terms of they're the questions I'm answering at the moment. So still a little bit behind, but we actually didn't get that many, about 13 questions in June, quite a bit in May. So anyway, I've got a lot to get through and I'll get through them all, but there's about a 2 or 3 month delay between when you send them in. Anyway, tomorrow, as I said, the super report, which I think is going to be a really useful tool to help people keep reviewing whether they're in the right super fund. Really important decision. So until then, bye for now. Before I go, my new book, Wealth by Design, is now available for pre-order. Pre-orders matter more than you think. They're used by bookstores and online retailers to decide how many copies of the book to stock. So, as a huge favour to me, if you're considering buying the book, I'd really appreciate it if you pre-ordered it now rather than wait. And the part that I'm most excited about isn't really the book itself, it's the AI companion tool that I've built to go with it. I reckon it's a game changer, and I'd love you to see why. The pre-order links are in the show notes. Thanks a lot.